ULTY is in trouble. Is a reverse split coming? Let's find out.
This video is not financial advice, nor is it a recommendation. Please do your own due diligence before investing into anything.
After ULTY's big crash last month, we saw a bounce that may have given investors hope. But now ULTY is dropped and is now beginning to retest its new all-time lows. Let's take a look under the hood and see if we can find out why ULTY is circling the drain. Right off the bat, when I look at the holdings, I notice they have two 3x leveraged ETFs, which not only experience decay, they also come with 3 times the risk of the average ETF. They also own direct shares of NVIDIA while also holding QQQ, which is a NASDAQ index ETF. NVIDIA being one of the top drivers of the NASDAQ in recent months adds more weight to the risk of holding NVIDIA, which has had its own problems recently. Because a drop in NVIDIA can itself cause a drop in QQQ, this is almost like holding a 2x leverage ETF on NVIDIA. Aside from the holdings we've mentioned so far, the rest of their list is very heavy in tech and fintech, with some Chewy stock and a little pharma sprinkled in. We do see that Coinbase and MicroStrategy are still on the list. However, Bitcoin hasn't been doing as well recently, currently sitting in the early 55K range as I'm recording this video. So that means Coinbase and MSTR will also suffer. If we go down the holdings list, you'll also notice more of these holdings are already being used as reference stocks in other YieldMax single stock ETFs. Normally it's maybe 1 or 2, maybe 3, but as I'm recording this video, I realized it is now up to 5. They have C3.ai, which is covered by AIYY, Coinbase, which is covered by Connie, MicroStrategy, which is covered by MSTY, NVIDIA, which is covered by NVDY, QQQ, which is covered by YQQQ, although that is a short ETF, but nonetheless, if these are in ULTY's holdings because of their previous performance under their single stock ETF tickers, then wouldn't it make more sense to just invest in those YieldMax ETFs rather than ULTY? If you're making an entirely separate ETF to seek out high volatility to bring in more income, why would you dilute those holdings with stocks you're already doing this same strategy on in another ETF? If these lesser known stocks are so good at bringing in premium income, shouldn't those be the entire list on ULTY? What we can take from all this is that their heavy focus on high volatility might lead to higher premium income for each contract, but comes at the cost of their original capital investment, especially when they hold direct shares in these stocks. As much as I've been rooting for this ETF to work, I can't help but notice it hasn't. If we go back to the daily chart, since inception it has only trended downward. I know most of those invested in ULTY just care about the dividends, but if we take a look at the total return on this ETF, Seeking Alpha has this at a negative 16.45% total return, and a price return of negative 46.67% since inception. At the rate ULTY is going, unless there is a radical change in the strategy of this ETF, or at least the execution of said strategy, I don't see this going much longer without a reverse split. Is ULTY doomed to fail? What would you do to fix this ETF? Let us know in the comments below.
If you like this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell for notifications so you don't miss a single video.